Good morning, everyone, and welcome to our DATIQ weekly market update. This is our update for July 19th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT. And it's just the two of us today, Dean. We got Dean Croak, Principal Industry Analyst, here joining us this morning.
Yeah.
How are you, Dean?
Good, Ken. Good to be with you.
Feels awfully lonely here.
It does, doesn't it? I was just thinking it's the first time we've been without Ned for a long time. It's been such a staple.
I know. Yeah. Wishing him all the best. I wanted to pop in and join last week. It just wasn't possible from where I was and what I was doing.
No problem.
So for those new to the show, we're here every Tuesday at 10 a.m. Eastern talking about trends we see in the freight market, data that we're analyzing. Occasionally we have guests, but most importantly, we're here to answer your questions. So go ahead and drop those in the comment section below. Our illustrious marketing team will get those over to us. And we will respond at the end of the show. We do have a lot to cover this week, so I'm going to dive right into our key points of the week. Really interesting trend in dry van and reefer. Dean's going to show you the graph, but we've sort of plateaued right through 2018. Anyone who was in freight and logistics in 2018 knows that after the 4th of July, the market effectively fell off a cliff. More on cliffs later. That has not been the case this year. I think with the fuel prices ebbing back a bit, we're getting some relief. Rates have been rather steady. Coming as a shock to no one. I don't all the credit to Jason Miller here, but I don't know that you need to have a PhD to realize there was no freight recession in Q2. MSU for higher trucking ton mileage up 1.4%, and even up versus 18. Pretty much all the major volume indices, ours included, showed Q2 coming in rather strong from a volume perspective. Again, not much of a surprise there. June retail sales up 1% month over month, 8% year over year, despite inflation. Again, we talked about cliffs in an article that aged like milk. June U.S. imports for Asia up 12.7%, seeing really high increases in TEU volume, busiest June ever on record, as retailers are loading up for fall. We saw a record Prime Day. Again, not the drop in import volumes that were purported. And then June Class 8 truck auction prices down 17% month over month, mainly due to rising inventory and perhaps some softening demand for those used trucks. I will turn it over to Dean to walk us through the market update. Dean?
Yeah, thanks, Ken. We've been watching auction inventory pretty closely. We're nowhere near the just over 1,100 trucks at auction back in June of 2018. It was when we had a pretty high number of bankruptcies. We're nowhere near that level just yet. So, but inventory levels are up in June, which was a trend we're watching closely. All right, so let's start our market update with the load to truck ratio. In dry van, load post volumes bounced back last week. They were up 12%. Equipment posts, though, were up by 31% last week. That's the highest level ever recorded for mid-July. But at just over 1.1 million load posts, volumes are about 21% lower than this time last year, but still 51% higher than this time in 2018. Last week's load to truck ratio decreased slightly to 3.94. And in the refrigerated sector, long haul produce volumes were down by just over 13,000 truckloads last week compared to the previous year, but there was a slight weekly increase for the first week of July, ever so slight. Load post volumes in the reefer sector are up by 1% week over week. But like dry van, reefer carrier equipment posts are at record high levels for this time of the year, now 2% higher than the oversupplied 2019 reefer market in mid-July. Last week's load to truck ratio dropped back to 7.38, almost identical to this time in 2020. In the flatbed sector, load post volumes are almost identical to mid-July of 2018, following last week's 12% week-over-week increase. Similar to dry van and reefer, flatbed spot market is seeing capacity loosen rapidly after the previous week's 29% week-over-week increase in carriers posting their equipment for loads. Equipment post levels are also at record highs for this time of the year, but they're also less than 1% below the highest ever level recorded, which was in late 2019 for flatbeds. Load to truck ratio last week ended the week at 23.27. Having a look at our market condition index, starting off with dry van, a little bit of a focus around the port markets, as Ken alluded to at the start of the show. The Port Authority of New York and New Jersey took the #1 spot for the first time in many months, away from the Port of Los Angeles for the highest volume of containerized imports in June. Following June's 15% month-over-month increase, import volumes are now up about 24% year-over-year in Elizabeth. That's driving higher spot market truckload volumes for about the fifth week in a row. Load post volumes are up 32% in the last month after increasing 14% last week. Capacity tightened over the same time frame. Line haul spot rates in Elizabeth increased just by a penny per mile to an average outbound rate of $1.73 last week. That's up 8 cents a mile in the prior month. Loads north to Boston, it's only $233 miles, but loads increased by $26 per load to an average of $1,069 a load. That's the first time line haul rates on this lane have increased since February, when they were about $340 per load higher. Spot rates from Elizabeth to Atlanta have been heading in the same direction, which is south, now slightly below the June average of $1.48 per mile. And out on the west coast in California, Stockton and San Francisco markets were the only two to report gains last week. Combined outbound spot rates are up 2 cents a mile to an average of $2.09, while rates dropped 4 cents a mile in the other four markets, Los Angeles, Fresno, Ontario, and San Diego, where line haul rates average $2.26 per mile. Having a look at the refrigerated market condition index, despite July being National Watermelon Month and higher volumes of watermelons this season coming out of Florida, reefer spot rates in the largest growing region in the country continue to cool, dropped 11 cents per mile last week to a state outbound average of $1.45 per mile. That's down 31 cents a mile in the prior month. In Mobile, Alabama, capacity tightened last week. Spot rates jumped 39 cents a mile to $2.19 on average. Loads west to Phoenix. It's about 1,700 miles from Mobile to Phoenix. Rates were up 9 cents a mile last week to an average of $1.89, just 11 cents per mile lower than this time last year. So good rates coming out of there for carriers. On the short haul lane from Mobile to Orlando, spot rates were up 35 cents a mile above the June average. Last week they averaged $3.38. In Chicago, reefer rates continue to climb, averaging $2.56. These are line haul rates, excluding fuel, averaging $2.56 for outbound loads, following last week's increase of 5 cents per mile. Chicago reefer rates have increased by 18 cents a mile also in the last month. Load post volumes are up by 46% in the same time frame. On the 1,200-mile lane from Chicago to Orlando, rates averaged $2.15 last week. That's the first time rates have increased since January, when they were about $2 per mile higher at $4.15 a mile. Chicago to Seattle, capacity tightened also, up 7 cents a mile to an average of $1.72. That's 14 cents per mile lower than this time last year. And having a look at Flatbed, in the Pacific Northwest market of Seattle, capacity tightened. There was a surge in load post volumes last week. Load posts were up 35% week over week. Outbound spot rates were up also in Seattle, rising by 12 cents a mile to an average of $2.48. High volume lane to Reno, 750 miles to the south, spot rates were up slightly to an average of $2.32, despite dropping for the prior 4 months, and are now just 6 cents per mile higher than this time last year. In Houston, there was a 12% month-over-month increase in import volumes last month. They're now up 20% year over year. What that's doing is pushing a lot more volume into the flatbed market, as it does traditionally. Load post volumes in Houston were up 32% last week. Despite all of this capacity ease, plenty of trucks in the market. Last week, spot rates decreased 14 cents a mile to an average market outbound rate of $2.87. One of the busiest lanes we watch out of Houston is north to Fort Worth. Spot rates dropped 32 cents a mile below the June average of $3.58 last week. It's still 28 cents per mile higher than this time last year, so still pretty good rates there, but capacity is loosening. And in the smaller market in Massachusetts, Springfield, it's a major manufacturing center here in the Northeast. Capacity tightened last week. Load post volumes were up 62%. Spot rates jumped 34% to $2.68. Now, wrapping up our market update this week, having a look at year-over-year spot rates. Dry van line haul rates decreased by just under a penny per mile last week to a national average of $1.97. Line haul spot rates are 41 cents per mile lower than this time last year, still 28 cents per mile higher than the average of pre-pandemic years. Having a look at our top 50 lanes measured by loads moved, on the top 50 lanes, the national average dry van rate was $2.39. Which is about 42 cents a mile lower than the national average. And as you can see from the chart, they're exactly where spot rates were in 2018. Having a look at the refrigerated market, spot rates are now 2 cents per mile lower than this time in 2018, following last week's 3 cents per mile decrease to a national average of 2.24. That's line haul excluding fuel. Compared to the previous year, reefer spot rates are now 54 cents a mile lower, but still 28 cents a mile higher than the pre-pandemic average for this time of the year. And wrapping up our market update with flatbed, as the heat goes out of the flatbed spot market, line haul rates are now down for 7 weeks in succession, following last week's 2 cents per mile decrease to 2.49. Spot rates are down 9 cents per mile in the previous month and about 18 cents per mile since the start of the year, but still 8 cents per mile higher than this time in 2018. So that's it for this week's market update. Remember, if you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published this evening. And with that, it's Ken for the short-term forecast.
All right, here we go, everyone. It's going to be a few weeks of me pretending to be Ned, which I'm sure you're all thrilled about. But we are going to walk through the short-term forecasts. So like always, we're going to start with dry van. The blue line is historical. And then each of the lines to the right in varying colors represent a different forecast. So in the green is ratecast, the red is our short-term forecast, and then the gray and the yellow are blends of the two. So I think on the dry van side, the big takeaway here is forecast mainly in agreement that we're going to see steady state. I think that in and of itself, if you're looking for wins in a down freight market, is a good thing. This is a point of the year where you would expect seasonality to be pushing rates downward. If we can hold on to pretty much any of these four forecasts, I think it will be a positive as we roll into back to school at the tail end of August and into Labor Day. So moving on to reefers, again, same lines, same colors, everything's the same, except this is for refrigerated. Pretty much in agreement here as well. Ratecast is the optimistic one. The red line being the short-term forecast is a bit pessimistic. I think you're seeing some of that a little bit more pronounced post 4th of July pullback, which is what the short-term forecast is picking up on. But Ratecast pretty much has a steady state at that 225 line heading through mid-August. This is the one that's really interesting, and I'm going to tease our question of the week here. But from a flatbed perspective, the models don't really agree. Ratecast is a bit more optimistic, expecting the rate of decline to slow a bit, but the short-term forecast really has us continuing downward on the trend that we've been plotting along pretty much this year. And then the two blended forecasts seem to shade closer towards the short-term forecast than Ratecast. So I think something really to track here in flatbed. Flatbed's a really good leading indicator for a lot of industrial markets, home building markets, energy markets. So that is something we're watching, which leads us to our DAT IQ question of the week. How are current economic conditions impacting the flatbed market? So we saw the impact, but now it's time to talk about how those current economic conditions are impacting it. And Dean and I chatted this morning, and he came to this conversation loaded with tons of data and information. So I will turn it over to Dean to kick us off here.
Yeah, thanks, Ken. Let's set the stage with some data points that have emerged, starting with this morning's release from the Census Bureau of the single-family and multifamily housing starts. They were out for June this morning. So single-family housing starts in particular, we track. They're the most freight-intensive for flatbed carriers. So single-family homes, the number of houses started in June were down 8% last month. That's down about 15% compared to this time last year. The other data point we look at, single-family permits. They are a leading indicator of houses that will be constructed in the future. Single-family permits in June were also down 8%, down about 9% year over year. Having a look at the volume of homes, we're about 5% below the volume of single-family homes built in February of 2020, right before the pandemic started. But we're building about 13% more new homes versus June of 2018. That number translates to about 115,000 more. So despite the drop in volumes, we're still building more homes than the excellent flatbed market back in 18. The Fannie Mae Home Purchase Sentiment Index down to the lowest reading in a decade. building confidence is down from the National Association of Builders. Their index plunged to it was the largest decline in the history of the index. I took a look at some of the Standard & Poor's data on steel production. We're past the peak in steel production in terms of net tonnes, which is in March, April each year. Currently, as of June, we're down about 8% year to date compared to the first 6 months of last year. That translates into about 116,000 fewer truckloads of steel, or truckload equivalents. But we're down about 4% year to date versus the same period in 2018. So less steel than 2018 as we start June, or as we end June and start July. And the other data point we looked at, Ken, was some of the flatbed and drop deck specialised freight, which comes from the Association of Equipment Manufacturers. This is the sales of two-wheel drive and four-wheel drive broadacre farm tractors, combines. In June, the number of agricultural equipment sold, which again peaks in March ahead of planting season. June, we're tracking identically with the 5-year average, but interestingly, up 15% year to date versus 2018. Two-wheel drive tractors are up 13% year to date, mostly flatbed. When we get into the four-wheel drive tractors, we start to get into the drop deck specialised category with the wide loads. Those sales are up 11% year to date. Combine harvesters, which are on this drop deck specialised outrigger trailers, are down 6% year to date. So lots of good data points there. We're certainly better than we were in 2018 across most of the high volume data points that we're looking at, in particular steel and lumber, despite volumes or despite spot rates cooling off at the moment.
Yeah, I mean, there's a lot. It's been interesting, right? I mean, so throughout most of the pandemic, we've been looking at flatbed as sort of the more insulated of the three core truckload modes that we track from some of the COVID shenanigans, right? If we were looking for like a true market signal, we would turn to the flatbed market. And as I scroll back in the presentation, and anyone watching can just go back after we're done and look at Dean's piece when he showed the year-over-year flatbed rate charts, because I think that does a really good job of showing pretty much exactly how in 21, which would be the red line in that chart, it followed the 2018 line, but like on stilts, right? I mean, the movement was relatively the same shape. And now as we've entered into 22, which would be the purple line, if you go back and watch that section of the video, you'll see it essentially fall most of the beginning of the year, and it's sitting right now, the lines are pretty fat, so there is some room, even though it doesn't appear that way, but it's sitting right on top of that 2018 line and trending in that exact same direction. So I think, again, I don't sit around and worry about 2016 was that when industrial production was at recessionary levels for several quarters. I don't know that I'm ready to worry about that. I think acutely you're seeing interest rates and inflation take a toll on things that move via flatbed, whether that's sheets of building products and 2x4s, and new housing, and commercial building products. I'm sure that inflation and interest rates are taking a toll. I mean, I refinanced a year and a half ago at 2.1%. I think to go do the same thing, I'd be at 4-point-something% right now. That's a big difference. I mean, that's hundreds of thousands of dollars worth of home in a lot of people's cases, less that you can afford. So it might be the case of not putting that back deck on, or this or that. People with variable home equity lines of credit have seen that, and it's pegged off the prime rate. That's gone up. That might put a remodeling project off to the side, or you might choose to have the porcelain instead of the travertine in your bathroom. Right? These are like the little. This is kind of like the ground level economics that happen as a result of inflation.
Ken, you mentioned 2016, right? We saw the 17 freight market take off after the 2 Cat 5 hurricanes that came in the Q3, I think, and then we're off to the races in the early part of January 18 with one of the best flatbed market rate rallies we'd seen in quite a few years. Some of the market pundits back then described the 2018 market as the tightest capacity market we'd seen in a decade. Of course, that was until just recently. But I think we're into hurricane season can change things pretty quickly in the flatbed market, particularly in the southeast, where the majority of single-family homes are purchased. So even though things are trending down, things could change pretty quickly in the flatbed market. But I think we're heading into that quiet period of the year before retailers start to restock their lumber inventories over winter.
Yeah, I don't know, D. I mean, I think there's a lot. I had the pleasure of playing golf with one of the largest flatbed carriers in the country a couple of weeks ago, and they're seeing their volumes and their margins. I won't disclose who it was, but they're seeing volumes and margins compress a little bit. I think for the most part, they're still on a fuel scale, so they're benefiting from that, right? The fuel hasn't been punishing them. But if you're like a small, the other thing we don't kind of talk about a lot is that the flatbed market has a much higher percentage. It's much more fragmented. You don't have, like, at least I'm not aware, other than a couple of the big holding companies, there's not like a Schneider-sized flatbed fleet, or at least not a handful of them like you would see at the top-heavy truckload markets. So you have a lot more small businesses. A lot of that stuff might be negotiated on a project basis. So if you locked in a project to move 5 RGNs with, I don't know, heavy equipment on the back 3 or 4 months ago, which would not be uncommon, and then fuel moved in the wrong direction and you're unable to renegotiate, that could kind of put a cramp on your margins or whatnot. So, and then like coiled steel and a lot of these things are upstream of current economic conditions, which is why flatbed's such a good leading indicator of where things may be headed, especially in the industrial and consumer durable side. So
there's still lots of construction going on, like where I am here in New England. There's still a lot of houses being constructed, but I think what's more common is the renovation side of the industry. There's a lot more renovations going on than this time last year here in New England. We're trying to get renovations done on a house. We can't even get people to quote, let alone do the work. Just getting a quote done is extremely difficult. So still labour shortages. Part of the good side of the delay is that maybe lumber prices will drop in some of these quotes that we're seeing that are coming in well over double what we were expecting to pay for 2x4 dimension framing lumber.
Yeah. I mean, I think, it's one of those things where I think you just got to, like, you're in kind of like the early stage where you're setting a course, maybe for like where 23 is going to play out in the flatbed sector. So I think it's important to keep an eye on right now. As I mentioned before, I don't know that it's at a point where you get alarmist about it, but there's this phenomenon, right? And I was reading about this yesterday morning, that you're going to see, like, there's a potential now where we're setting the stage for a large lack of mobility among home buyers, right? Everyone who bought their house a year, like 1 to 3 years ago, is essentially going to be priced out of an equivalent home under the current interest rate regime. So there's like this sort of immense amount of friction that gets put onto the home market, where if I bought a $500,000 house at 3%, and I took a mortgage, right, which implies I didn't have the cash to buy it, like a 20% down mortgage, I certainly don't have the cash, presumably, to buy that same house at 5% or 7%. So either I'm going to buy a significantly cheaper house, which we know housing prices haven't collapsed a la 2008, or I just stay put. And I think the overwhelming consensus is that people will stay put, right? Even if wage growth stagnates, if we don't see tremendous a number of layoffs, which we haven't seen thus far. I mean, other than like some of the tech and some of the VC, PE-backed companies, it's been relatively steady. As long as I had the income to support the house when I bought it, and there's no material change to my household income, even if I get the itch to move, I'm going to stay put, because I just frankly can't afford an upgrade. I will be putting that entire upgrade into interest, right? I'll just be paying the bank. It's the exact opposite of the phenomenon we saw over the last 1 to 5 years, where people were able to significantly upgrade their homes and pay less, right?
Yeah, absolutely.
Because you don't have the interest expense.
Exactly.
So
the other data point that came out this week, Jason Miller did a good post on it, was about the number of oil and gas drilling rigs in June surpassed the previous peak of the prior administration, which was December 18. So we're seeing a pretty high number of wells being opened up Of course, that production will come online later, and there's a lag between when you start and produce. So, but that's good news in terms of production. What it also means, though, is a decent amount of volume now starting to move in the flatbed market for drill pipe casing, bulk cement, sand, things like that.
Yeah, I mean, I'd like to think this is the way you're supposed to analyze things, right? Where you look at a trend emerging and you start to like watch it and kind of nurture what you're seeing and draw perhaps some possibilities, but not, pull the fire alarm and run out of the building whenever you start to see a downturn in a particular market. So let's get to some questions. I know we have a couple. So Brian Carlson, Dean, you mentioned last week that drayage workers might have an action at LA ports. What happened in the end? Is there still a risk of a strike or a slowdown?
Good question, Brian. In fact, they did protest last Monday. So it was the Monday before. It was Wednesday. Gosh, I can't remember the exact day. It was about 400 carriers protested. To put that into context, Brian, there's about 21,000 carriers registered to work on the Port of Los Angeles and Long Beach docks. So it's about 2% of the carriers actually got into the protests, slowed down traffic. I noticed on social media overnight there was some conflict. I don't know whether it was staged or real, but the truckers were blockading the entrance to the ports in either Long Beach or Los Angeles. But that's pretty interesting that the two unions, or that they're fighting against the longshoremen there. Similar events reported in Oakland this week. They protested yesterday. Similar number of carriers reported protesting up in Oakland. There's about 9,000 owner-operators registered to work at 9,000 trucks, registered to work at the Port of Oakland. About 400 trucks protesting there today, and some talk of more protests today. I think it was originally scheduled to protest for 3 days in Oakland. But again, 9,000 owner-operator or 9,000 trucks in that port, and about 80% are owner-operators, according to local sources. So still a lot of activity going on. It's far from done. I think it's certainly isolated. The whole AB5 controversy seems to be very much isolated to these dray carriers in Oakland and Los Angeles and Long Beach, just based on what we're seeing so far in the media.
Yeah, I mean, to recap, it might be nice to add a little addition to the show of like parting points. You even got the alliteration, but I mean, you got the labor contract for the West Coast port workers. You got AB5. You've got the potential for rail apocalypse 2022, which seems relatively low probability of happening, but huge impact if it does happen. And then I think on the positive side, you've got diesel that's come down. We've got to be into the 30 cents of decrease, right?
38 cents a month, down 14 cents last week.
Yeah. What's the total incremental down from the highs? It's got to be 30 something.
38 since the 581 4 weeks ago.
I would have guessed 30 to 40 cents. So that's good, right? That's 6 miles per gallon. That's what, 6 cents a mile that you're not having to pay at the pump. So that's good. The hopefully influx of supply that should be coming online should continue to drive that down. Especially as we get into like the fall futures contracts. I'm hoping that we start to see even more relief. I think EIA has fuel forecasted around the end of the year around 4 something. So that would be good.
Yeah, exactly. Yeah, we're looking forward to that.
So plugs, Dean, to bring us home here?
Yeah, this week I'll be on the Landline Now show at 7 p.m. Eastern tomorrow night on Road Dog Channel 146 on Sirius XM. That's 7 p.m. Eastern tomorrow night. I'll also be on Sales Chatter with Dan Deegan and DJ Flores at 9 a.m. Eastern for Data Wednesday. You can connect with them on LinkedIn.
All right, so we'll be here next week. If you have any questions, askiq@dat.com or hit us up on LinkedIn. We love having these kind of midweek follow-up conversations. But in lieu of that, stay safe. I know it's going to be really, really hot through most of the country this week, so I'd encourage you to stay hydrated, especially if you're out there on the road in the cab of a truck. Right, those long hours in the sun can dehydrate you. So make sure you're staying hydrated, stay safe, and take care of yourself. So with that, we're going to sign off, and we hope to see you next week. Bye, everyone.
Bye.